Guys, truth is, most traders starting out are focused on the wrong thing. Most traders obsess by overfitting to better entries, better exits. They usually think, oh, if I add one more indicator, I'll become more profitable. The truth is, these issues are downstream of something that's much more fundamental. You need to have a solid understanding of the statistics behind your strategy. Not just your last 2 weeks or the last couple of days, but mathematically over time. Because the truth is, you can have a 70% win rate and still be red on every single trade. This series is about what actually drives the results in your trading and the actual quantitative side of trading. I believe risk management is one of the most important concepts to cover first, as this usually determines whether accounts grow or die. So anyways, we'll get into it right now. So the most important value to know as a trader is the expectancy of your strategy. Now bear with me, this formula might look complicated, but it's really quite simple. Your expectancy, also referred to as mean or average, is the summation of first the probability of winning a single trade times your average win minus the probability of losing a trade times your average loss. Going back to that example earlier in the intro, this strategy would have a 70% win rate. I'll give you a couple seconds to try and guess if this yields a positive expectancy or negative. Right, so it turns out that this strategy actually yields negative results, meaning on average you lose about $25 per trade. But let's try flipping the numbers. In this difference, your win rate's 40%. You stand to win $300 while risking $100 per trade. Now you actually stand to gain $60 on average per trade. So even though you have a win rate below 50%, you stand to gain about $3 per risk of $1. So this might be somewhat unintuitive because I feel like when most traders start out, the thing they focus on is win rate and having that win rate above 50%. But that's not necessarily the most important thing actually. What matters just as much is your RR. And let's plot out both of those expectancies just to have a clearer visualization. And this is exactly what you want when you're trading. This variance is very minimal, whereas obviously our first strategy, even though it has a 70% win rate, which would seem like it's profitable, there's much more variance and it's obviously a negative strategy. All right, so now that you guys have a basic understanding of expectancy, you guys have heard me mention variance now a couple times in this video. Why is it important? Simply put, this is how prop firms screw you over even if you have a profitable strategy. Expectancy tells you the long run drift per trade, right? Whether you stand to be profitable or unprofitable over the long run given a large number of trades. Variance, or a similar measure, standard deviation, pretty much tells you how wide the swings are around that drift. Why is this important? Well, you need to minimize your variance as much as possible to stay within drawdowns to actually let your expectation play out. We won't go too deeply into the variance formula here, but all you need to know is that it includes your expectation. Just don't forget that lower variance is better, even if you have the same edge given two different strategies, because you'll still climb towards the same expected profit, but with smaller drifts from your expected value. It's much easier to be confident that you'll stay within prop firm drawdowns or manage trailing drawdown properly. That's why it's important. It's less likely you'll get stopped out, and you'll maintain a tighter distribution. This just makes your edge more reliable over time. Now let's look into the actual specifics of two strategies that have the same expectation. So both strategies, you stand to make $10 on average per trade over the long run. Per trade standard deviation for strategy 1 is $20, and there's a much higher standard deviation on the second strategy, which is $100. Median max on the first strategy is minus 60 and the high is minus 780. This is the median max drawdown. Final probability of your P&L being negative for strategy 1 is low. It's pretty much 0. And for the second strategy, there's a 17% chance of your P&L ending up negative, even though the expectation for both strategies is the same. So again, here's it charted out. Same expectancy for these two strategies, but different variances. You can see a deviation around the equity curve on the drift, whereas the second strategy with much higher variance has much greater swings. When you're building a strategy, your total trades, you want this to look like a very tight distribution, with the exception of having a fat tail end distribution on the right. All that means, generally speaking, is that your strategy may let winners run. Whereas this second strategy, due to high variance, you have really large swings of losses. In this case, sometimes losing about 1,000 per trade. Whereas this strategy stands to lose at most 400 per trade, even though they have the same edge over time. So to sum up, expectancy tells you the direction of profitability, and variance tells you if you'll survive long enough to actually get there. You need to know both of those numbers before you risk $1. If you found this video at all in any way helpful, don't forget to subscribe and like. I appreciate it a lot. It's just the beginning of the series. I'll be releasing a video weekly.